Hey guys, welcome to an all new video. Now today we're going to talk about a split share fund. I'm just going to tell you guys quickly about what this is, and the reason I'm doing this is because the next stock I'm going to be talking about in my portfolio picks is a split share fund. Okay, so I just want you guys to understand exactly what this is, and so you can come back to this video for reference in the future if you need it. So I'm just going to use this document here by Quadravest Capital Management because it's fairly succinct, it's fairly short and compact. So we're going to get through this fairly quickly. So first off, a split share fund is exactly what it says. It's a fund that is composed of two types of different shares. So this is very different from a stock split, so you need to be careful here. This is not a stock split where a company divides its number of outstanding shares to increase it and to decrease its price per share. This is a split share fund. So this is a fund. This is a totally different animal. So what kind of fund, stocks or shares, should I say, do you have in a split share fund? So this particular case is made up of preferred shares and Class A shares. Okay, so you can have more than one type of share, but in this case, there's only two classes of shares. So a preferred share is a share that is a little more conservative. So in this case, it's a dividend fund. So you're going to want to get a fixed amount of monthly dividend that is fairly conservative and very reliable. So it's not going to get cut, and it's going to be there for you month after month. It's not going to increase, it's not going to decrease, but it's going to be there. And the price per share is not going to change at all, or not by very much. So what you're going to bank on is that fixed cumulative monthly payment. As opposed to a Class A share, which is a lot more dangerous, if you will, there's a lot more risk involved, where they have a targeted monthly payment with the potential for special payments plus any benefits from the portfolio, the underlying portfolio. But what they don't mention here is that you have a potential for magnified gains, but also a potential for magnified losses, and we'll see exactly why here. So these are examples of split share funds, so that are managed by Quadravest Management Capital. So you have different sorts of baskets in which you can choose to invest, different themes, if you will. These ones are all about financials. These are dividend yielding companies. These are Canadian life companies, Canadian banks, Canadian banks, utilities, and life companies. So a little bit of a mix here, and so there you have it. So they're a lot like funds, but then again, you can choose to have a more conservative share or a more aggressive share. So what exactly is a split share fund? Like I said, two types of share. The underlying fund typically holds a basket of high-quality dividend-paying companies in the portfolio, so respecting the theme that we mentioned earlier. So you guys can choose to invest in a specific theme, if you will. And what is special about a split share fund is that it has an inception date and a termination date. Okay, so they will, if you will, they will expire after a while. So you will have to or you will be asked to trade them back in, and what you get when you trade them back in is very dependent on what type of share you have and what the net asset value of the underlying portfolio is. So a preferred share, let's say I buy a preferred share, I just want to get that steady monthly income in terms of dividend, so I get a preferred share. I pay, let's say, $10 for the preferred share at the moment of inception. Let's say today, July 12th or July 5th, 2017. So I buy a $10 share and I hold it for until the termination date. So let's say the termination date is in 5 years. And so every single month I get that steady dividend income. But at the termination date, I am guaranteed to get my $10 back if they are able to pay me that $10. So if the net asset value is worth at least $10 per share, they will give me back $10. If it's not, they'll give me back less, but I will be the first one to be paid versus the Class A shares, where the Class A shares will get whatever's left after I am paid up to my maximum of $10 like I initially paid for the stock. So I'm almost guaranteed to benefit from that steady monthly income, and then at expiration date get my money back, get my initial investment back. So that's sort of what the deal is here for the preferred share. The Class A share, you can participate in the underlying capital appreciation or depreciation if that happens. All right, so let's say I buy a Class A share, $10 at inception date, and so I get a fairly regular or irregular, if you will, monthly dividend income. And at expiration date, what is going to happen is that the preferred shareholders will get paid first. If the net asset value per share is worth, I don't know, let's say $12, let's say the underlying stocks in the fund appreciated in value, and the net asset value has now increased from $10 per share to $12 per share, then they get paid $10, and as a Class A shareholder, I get whatever is left from that $12 minus $10, so I get $2 per share at the expiration date. Now you're going to say, well, why would I ever want to invest in something like that? Well, the monthly dividend income that I get from a Class A share is significantly higher than the one I would get from a preferred share. So we're going to take a look here just underneath, and I'll go into more detail when I talk about the actual split share fund that I am invested in, because I'm a Class A shareholder, and so you'll understand exactly what that means and what the potential upsides could be. So which share is for me? Like I said, the preferred share is a little more conservative, but you're going to get that steady monthly income. The Class A share of a split can result in magnified gains or magnified losses due to the structure of the underlying stock portfolio. So how exactly are these monthly distributions funded? Well, in the case of a preferred share, the underlying stocks, like they said, they hold a basket of dividend-paying stocks. All right, so whether it be Canadian banks, Canadian life companies, life insurance companies, they are dividend-paying stocks. So in this case, Quadravest Capital Management gets regular, usually quarterly dividends that they use to then fund the dividend payments that they make for the Class A shareholders. Okay? So fairly similar to if you were to hold the underlying portfolio's stocks, but you're not exposed to as much downside if there is a decrease in value of these stocks. So basically, they get paid dividends, they distribute these to the preferred shareholders, right? So fairly simple. As for the Class A shareholders, how do they manage to get a higher and a significantly higher monthly dividend income? Is that any dividend income that exceeds what the payment to the preferred shareholders is, that gets distributed to the Class A shareholders, and any option premium, because they also play options on their underlying stocks to maximize and to increase the potential gains, and that's how they fund the monthly payment that they make to the Class A shares. Now, these aren't guaranteed payments, as opposed to the preferred shares, where these payments are absolutely guaranteed. So the preferred shares are always prioritized compared to the Class A shares. So you're not guaranteed a steady monthly income. Okay, so we'll go into more detail, like I said, when we discuss the split share that I'm invested in. Okay, so that is basically it. That's the gist of it. You have one fund, two types of shares: a conservative, steady, monthly paying share, and a more aggressive, not so reliable, or maybe reliable, we'll see, very high dividend yield, monthly paying share. That is the Class A. Like I said, risky versus conservative, Class A versus preferred share. That is the two options. And the other particularity that is with a split share is that it has an inception date and an expiration date, which is subject to further 5-year extensions whenever they get within 1 year of their of their supposed expiration date, they can expand for another 5 years. So prolong, if you will, their life for another 5 years, and they can do that as long as they want. So you might not even have ever an expiration date. Okay, so I hope this this answers some questions. Probably it creates more questions than it answers, but my next video that we'll be following up shortly will be on the split share fund that I am invested in, so hopefully we'll shed a little bit more light on this this type of investment. So if you like this video, guys, don't forget to leave a thumbs up, leave a comment down below, and don't forget to subscribe. Don't forget to share this video as well if you like, and you can follow me on Twitter to be notified as soon as a new video comes out. Thanks, guys. Have a good one.